So if you were looking to invest in, the absolute king of home technology, you probably wouldn't go hunting for a company that was founded way back in 1947.
Right, especially not one that made its first millions selling paper and cardboard.
Exactly. I mean, they weren't in some dusty Silicon Valley garage. They were operating out of Kyoto. And they weren't even called Nintendo back then. They were Marufuku Co.
Yeah, making those traditional Japanese playing cards, the karuta.
Right out of heavy paper. Welcome to the Japan Stock Podcast for a brand new deep dive. I'm stepping into my role as a senior investment analyst today, and our mission is to analyze a huge stack of recent investor relations documents.
We're looking at annual reports running up to March 2025, and of course those critical Q2 fiscal year 2026 briefings.
Exactly. We're going to strip away the colorful consumer branding and really guide you through the hidden business logic of this absolute giant of home entertainment.
And that underlying business logic is, well, it's highly unique. Because you have this massive tech pivot from physical cards to digital entertainment. But their core philosophy under President Shuntaro Furukawa hasn't really changed.
Yeah, it's surprisingly straightforward.
Very. It's officially stated as bringing smiles to people through entertainment.
Okay, let's unpack this because, from an analytical perspective, bringing smiles sounds like a very soft, feel-good marketing slogan.
It does. It sounds great on a billboard.
Right, but when you actually look at their books, that wholesome philosophy is backed by an absolutely fortress-like balance sheet. I mean, looking at their consolidated financials for the year ending March 2025, they operate with a current ratio of 461%.
Which is just astronomical.
It is. To put that in plain English for anyone scanning their portfolio right now, for every single dollar of debt they owe in the short term, they have $4.61 in liquid cash sitting in the bank, just ready to deploy.
Yeah, their ratio of total liabilities to cash is, I think, 2.1 times. They're just sitting on a staggering mountain of liquidity.
And traditional analysts often penalize companies for hoarding that much cash, right? Like standard corporate finance theory says, hey, you should be doing aggressive stock buybacks or taking on cheap debt.
Oh, absolutely.
Yeah.
But with Nintendo, this extreme financial conservatism is it's a highly calculated defense mechanism.
Because the entertainment sector is notoriously hit-driven, right?
Exactly. It's incredibly volatile.
Mm-hmm.
I mean, a single failed console generation can bankrupt a standard hardware manufacturer. We've seen it happen.
Oh, yeah, many times.
So by maintaining this massive war chest, they ensure they can weather a catastrophic product failure. They can self-finance years of heavy R&D and bridge that gap between hardware cycles without ever having to go beg outside creditors.
Their cash is basically their armor.
That's a great way to put it. Consumer tastes shift so rapidly. If they release a platform that the market completely rejects, and that has happened in their past, they don't have to panic.
Right. They don't have to slash the workforce or take predatory loans. They just retreat to the fortress, tap the cash, and fund the next cycle. And we really saw the necessity of that armor in the timeline leading up to their recent reports. Because if you look at the financial performance for fiscal year 2025, it actually showed a year-on-year decline in sales.
Yeah, hardware numbers dipped, and software volume naturally followed suit.
But that dip, it was heavily scrutinized by the financial press, but context is everything here.
It really is. You have to remember that in FY 2025, the original Nintendo Switch was entering its 9th year on the market.
Which is an eternity.
An absolute eternity in consumer electronics. Just think about how many iterations of your smartphone you've been through in the last 9 years.
Right, at least 3 or 4. And there's also the comparative baseline we have to consider. Because the previous year, FY 2024, was heavily driven by these massive, once-in-a-generation software launches.
Oh, yeah. Zelda, Tears of the Kingdom, Super Mario Bros. Wonder.
Exactly. Those titles artificially spiked the revenue curve. So what we were seeing in March 2025 numbers wasn't some structural failure of the business model.
No, not at all. It was just the natural mathematical exhaustion of an aging hardware cycle. The consumer base was basically holding its breath.
Which perfectly leads us to the game changer, the critical catalyst that fundamentally alters their trajectory heading into FY 2026, June 5, 2025.
The launch of the Nintendo Switch 2.
Yes. And according to the Q2 FY 2026 briefing, this new hardware achieved the fastest launch pace in their entire corporate history.
And a big part of that was the ecosystem advantage. I mean, the day one software maker lineup was the most robust they've ever had.
They came out swinging. You had internal heavyweights like Mario Kart World, plus those enhanced Switch 2 editions of previous Zelda titles.
Right, which gave people an immediate reason to upgrade.
But, okay, I have to play the skeptical investor for a second here. Looking at the physical unit itself, it does not look like a revolutionary leap from the first Switch.
It really doesn't.
It's visually very similar, maybe just slightly larger. And usually, in the tech hardware space, failing to provide a massive visual overhaul is a pretty significant risk.
It is, but this is where we have to ask how Nintendo defines hardware innovation versus, say, how the rest of Silicon Valley defines it.
Right.
President Furukawa actually addressed this directly in the Q&A. The objective was never a superficial visual gimmick. All the innovation is under the hood. They engineered what they call a large vessel for software developers.
A large vessel. That's an interesting phrase. He's talking about processing headroom and memory bandwidth, right?
Exactly. On the original Switch, developers were hitting a brick wall. They were spending, half their production cycles aggressively compressing audio files, scaling down textures.
Just cutting visual corners everywhere to make modern games run on what was essentially an aging mobile chip.
Right. So by expanding that computational vessel, they're effectively buying back development time. Software creators now have the overhead to invent entirely new physics systems that were mathematically impossible on the old hardware.
Wow.
And at the same time, they completely rebuilt the peripherals. The new controllers use magnetic rails instead of physical sliding tracks.
Oh, which eliminates all that mechanical friction, the wear and tear that caused so many durability issues with the old Joy-Cons.
Exactly. And it allows for snap-on accessories for new input methods. They focused entirely on structural integrity and developer freedom while making sure the transition was totally seamless for the 140 million people who already owned the first console.
And that frictionless transition is so vital when you look at their global footprint. Because while they are headquartered in Kyoto, over 70% of their total sales are generated outside of Japan.
Oh, it's a massive global operation.
Yeah, the Americas represent their largest single market. We're talking approximately $3.1 billion in sales.
What's fascinating here is how that geographic concentration introduces a really severe geopolitical vulnerability.
The tariffs.
The tariffs. The Q2 2026 Q&A session spent a lot of time on United States trade policy. We are looking at a hypothetical scenario of a 145% tariff on goods manufactured in China.
Which is just staggering.
And a baseline 10% tariff on goods imported from Japan, Vietnam, and Cambodia. For a company shipping physical electronics, a 145% import tax is, well, it's catastrophic for profit margins.
It's business ending in some cases, but if we connect this to their broader operational strategy, you can really see the foresight in their supply chain management. Because they didn't wait around for the ink to dry on these new trade policies.
No, they didn't.
The briefings reveal that hardware destined for the North American market is already being produced primarily in Vietnam.
Right. And moving a consumer electronics supply chain is an incredibly complex maneuver.
It's a nightmare. You have to establish local component sourcing, train a completely new labor force, secure new shipping routes. The fact that their core console is already flowing out of Vietnam shows this was a multi-year preemptive strategy.
You completely shielded their primary revenue driver from that worst-case 145% bracket. They did acknowledge some exposure, though. Some accessories and the interactive amiibo figures are still tied to Chinese factories.
Right. But the heavy financial lifter, the console itself, is insulated. Though even in a 10% tariff bracket, combined with the constant fluctuations of the yen-to-dollar exchange rate, that puts immense pressure on their margins.
Definitely.
The immediate fear for consumers is that they'll just pass those costs down by raising the retail price of the hardware.
Well, Nintendo's management approaches pricing with a much longer time horizon. First, on the currency side, they actively mitigate exchange rate shocks through hedging.
By purchasing forward contracts.
Exactly. They lock in specific exchange rates for their future dollar or euro revenues. So if the yen suddenly spikes, their operating profit doesn't just evaporate overnight.
And President Furukawa was actually very direct about their pricing philosophy regarding the tariffs. He explicitly stated that even if the tariff premises change, they will not default to a mechanical cost-plus pricing model.
Right. They aren't going to just look at a spreadsheet, see a 10% manufacturing cost increase, and automatically hike the retail price of the Switch 2 by 10%.
He emphasized that pricing has to consider the, quote, customer's impression and the overarching momentum of the platform. They are launching their first new dedicated machine in 8 years. Rapid adoption is the absolute priority.
Because the hardware is basically a Trojan horse. The physical console margins are relatively thin anyway. The real revenue engine is the software attach rate.
Right, if they absorb a marginal cost increase on a $400 console, but that consumer buys 10 games at $60 a piece over the next 5 years.
The high-margin software revenue completely eclipses the initial hardware loss. Stalling the system's growth with a price hike would be financially counterproductive.
Here's where it gets really interesting, though, because that software revenue engine is currently facing an industry-wide crisis. And this is the most critical variable for Nintendo's future.
The development costs.
Yes, the cost and timeline for developing modern, high-definition games have just skyrocketed. We are seeing development cycles stretch from 3 years to 6 or even 7 years now.
Requiring teams of hundreds of engineers and artists. You simply cannot pump out blockbuster titles rapidly enough to feed a hungry consumer base anymore.
And if there's a massive gap in the release calendar, consumer engagement drops and the whole ecosystem stagnates.
To counter this, Nintendo is employing a dual-pronged software strategy. First up is backward compatibility.
Right.
By ensuring the Switch 2 natively plays original Switch software, the historical library instantly becomes a massive value proposition. A new consumer isn't limited to the launch window titles. They immediately get an 8-year catalog of optimized masterpieces.
That perfectly solves the problem for new users, but it doesn't quite solve the engagement problem for legacy users who are just waiting for the next big release.
Sure.
And that is where their second prong comes in, the evergreen strategy. Rather than abandoning a successful game to spend 5 years and $100 million building a sequel from scratch, they are heavily investing in continuous, massive updates for existing titles.
Yeah, the development team specifically highlighted this approach in the Q2 briefing. Just look at the financial mechanics of a franchise like Animal Crossing.
It's brilliant. By utilizing the existing game engine and asset library, they can develop significant expansions at a fraction of the cost and time.
And those updates inject fresh momentum, keeping the title on the sales charts for years. It dramatically extends the lifespan of a single software asset.
It really functions as a cultural flywheel.
Right.
They're shifting away from merely selling isolated entertainment products, and they're embedding their intellectual property into the daily rhythm of their consumers' lives.
Yeah.
A perfect, if kind of unexpected, example from the recent reports is the release of the Alarmo interactive clock.
Oh, the alarm clock.
Mhm.
At first glance, a video game company releasing an alarm clock seems like a total novelty. But if you analyze the technology inside it, it reveals a much deeper strategy.
Right. It's utilizing millimeter wave radar technology to track your body movements in bed entirely without cameras to trigger specific reactive game sounds. It essentially gamifies waking up.
You're immersed in the auditory world of Mario or Zelda before you've even opened your eyes. From an operational standpoint, this device is a highly effective microcosm of their broader IP expansion strategy.
Because they're also aggressively pushing into visual content, right? Theme parks, official retail stores, mobile applications.
Exactly. They are systematically deepening brand affection outside of the traditional console environment.
And financially, this lifestyle integration is the ultimate hedge against the volatility of the video game market. If a specific tentpole game underperforms, or if a delay creates a 6-month drought in the release schedule, the consumer's relationship with the brand doesn't decay.
They remain completely tethered to the Nintendo account ecosystem, through merchandise, movies, daily interactions.
The affection for the characters bridges that temporal gap between hardware generations. You remain a highly engaged potential customer, even when you aren't actually holding a controller.
It's a really sticky ecosystem.
So, moving from their consumer strategy to their internal governance, we really need to examine their capital allocation. Specifically, how management aligns themselves with the shareholders.
Yeah, this is a big one. In June 2025, right in line with the momentum of the Switch 2 launch, Nintendo executed a disposal of treasury stock.
They allocated exactly 11,000 shares, which was valued at roughly 147.6 million yen, to 14 directors and executive officers. And crucially, this was distributed as restricted stock compensation.
The restriction is the key mechanism here. They didn't just hand out cash bonuses that executives could immediately pocket, regardless of what happens next year.
Right. Restricted shares vest over a designated period. The executives cannot liquidate those assets immediately.
By utilizing restricted stock, the board fundamentally alters the psychology of the leadership team. It directly ties their personal financial outcomes to the long-term health of the stock.
They are heavily incentivized to make decisions that ensure the company is thriving in, say, 2030, rather than making short-sighted cuts to just pump up the quarterly earnings in 2026.
It perfectly aligns the risk profile of the executives with the everyday investor.
However, when we look at their broader policy toward those everyday investors, it remains deeply conservative. The reports make it explicitly clear that their primary objective is retaining earnings.
Yeah, they aren't executing flashy, aggressive dividend hikes or continuous share repurchases.
No. They understand the physics of their industry. They state clearly that retained earnings are mandatory to self-finance high-risk R&D and capital investments.
They will pay out dividends according to their established formulas, sure,
Yeah.
but protecting the integrity of the balance sheet completely supersedes artificial stock inflation.
So what does this all mean for you as an investor or just an observer of the tech landscape? Synthesizing these thousands of pages of briefings, the key variables dictating Nintendo's trajectory over the next 1 to 3 years are pretty well defined.
First, they have to successfully convert the explosive early adopter momentum of the Switch 2 into sustained mainstream market penetration.
Second, they have to flawlessly execute that evergreen software strategy. Leaning heavily on backward compatibility and continuous updates is really the only mathematically viable way to offset the crushing development costs of modern games.
Otherwise, they'll just burn out their internal studios. And third, they must navigate the incredibly complex geopolitical supply chain, relying on their Vietnamese manufacturing hubs to shield the core hardware from severe U.S. tariffs is going to dictate their ability to protect profit margins.
Without alienating their install base through massive retail price hikes, it is a very intricate, multivariable balancing act.
It is. And analyzing their strategy regarding software costs leads to a final, really unexplored thought to ponder regarding the future of this whole industry.
Oh.
We noted that the cost of building massive high-definition worlds is skyrocketing, which forces them to rely on evergreen updates and legacy IP.
Right, it's a major bottleneck in the current development pipeline.
But consider the rapid advancement of generative AI in software engineering. If AI tools eventually allow developers to generate high-fidelity 3D assets, write complex branching dialogue, and code physics environments at a fraction of today's cost and time,
The barrier to entry for creating blockbuster games could just plummet.
which completely disrupts the current economic model. If the market is suddenly flooded with infinite, cheap, high-quality games from thousands of independent studios, does Nintendo's evergreen strategy lose its competitive edge?
Wow.
Or, in a sea of endless AI-generated content, does the handcrafted, deeply embedded cultural legacy of characters like Mario and Zelda become the only true, irreplaceable differentiator left in the entertainment sector?
That is a fascinating question. It really forces us to ask whether their ultimate competitive moat is the plastic box they build or the decades of trust they've accumulated. When you analyze Nintendo's financials, you are looking at far more than a hardware manufacturer. You are evaluating a long-term investment in global cultural infrastructure. Thanks for joining us on this deep dive, and we will catch you next time.